India is losing the global money game. That's the story dominating global markets right now. Foreign investors have pulled out nearly $23 billion from the Indian stock markets this year, while pouring money into AI-driven markets like South Korea and Taiwan. And honestly, the numbers look brutal. South Korea's benchmark Kospi index exploded nearly 200% in 1 year. Taiwan's TAIEX surged almost 95%. Why? Because the world became obsessed with the AI gold rush. Investors bought shares of semiconductor giants like Samsung, SK Hynix, and TSMC, betting that AI would change everything. Meanwhile, India looked boring. No massive AI rally, no explosive semiconductor boom, no market euphoria. But now, something interesting is happening. Foreign investors are suddenly pulling billions of dollars out of South Korea and Taiwan. Why? Because when markets rise too fast, one dangerous question eventually appears. Are these valuations sustainable? And that's where India quietly re-enters the conversation. Because India's biggest strength was never hype. It was consistency. Historically, Indian equities have delivered remarkably resilient long-term returns, even in dollar terms, because despite rupee weakness, oil shocks, and global crisis. That's important because foreign investors don't think in rupees. They think in dollars. And when you study long-term rolling returns instead of flashy one-year rallies, India has actually been one of the most stable compounders among major emerging markets. Not Brazil, not China, not even many developed markets. That's the part most retail investors miss. Markets reward excitement in the short term, but consistency in the long term. Now yes, India still has real problems. Its currency, the rupee, remains weak. Oil prices and inflation are major risks. Corporate earnings growth has slowed, and foreign investors are still cautious. But India's valuations have cooled significantly compared to last year. Some sectors are starting to look attractive again. And if crude oil prices ease, foreign capital could slowly rotate back. Because global money is never loyal. It chases narratives. First it was China, then it became AI and semiconductors. Tomorrow it'll be something else. But across every cycle, India's real edge has stayed the same. Not speculative hype, not market mania, but resilience. And in investing, resilience compounds far longer than excitement.